And nobody's live streaming. See, somewhere this time last year, I had test one. That was 2016. I gave it in class last year. Let me bring this test up though for a minute. Now, since the law changed this year, Trump's new tax plan, we don't have to know as much about exemptions. But sometimes we need to know who a dependent is, definitely for a child tax credit or to file head of household or surviving spouse, maybe for filing status or for some of the credits. This goes way back to 2014. But number one, though, does make a little sense. Does anybody know what his standard deduction would be? How much? It would probably be 8. That's his wages earned, or we may be able to add 350 to that. Or was there a minimum standard deduction of around 6,200 that year? So you'd have to ask some questions. So your standard deduction, if you're under a certain age, it is your wages earned, but not over your legal standard deduction. 62 probably that year. Married person who files a separate return can claim their spouse. I don't know why you'd want to claim your spouse if you're going to file a separate return. Don't make sense, does it? It's not even a valid question. Read number 3 for what you know about exemptions. See if you can answer number 3. What would you say to that one, Jonathan? Oh? All right. Now, I know the laws have changed, but she maintains a home for her brother. Now, if this 4,000 is under the personal exemption, which is probably 4,100 this year, what would have been, she could have claimed her brother. Her 21-year-old niece, she could probably claim the niece. Now, the cousin, it don't matter if a cousin is enrolled in college or not. You cannot claim a cousin. Now, if the cousin had lived with her, that'd be a different story. So that's a few things that will be on your test. Now, I do have the test ready, and I could not use last year's text bank. And finally, this company got a test bank out just in time, JIT. Okay, so I think it's a fairly easy test, but I want you to tuck this away. And Cole, I'll give you this take home. You promise not to call Tom. That's everybody have a question. All right. Not even one, Cole. Okay. Same goes for you, John. You're not preparing notes on this table. Anybody that can't be here on Tuesday, it is due Tuesday. You've got plenty of time, even with the heavy rains that might come in. It's true, false, and multiple choice. It's chapter 2, 3, and 4. Now, you can dig into those chapters, and I want you to. It'll probably take us a whole period to go over this test because you'll learn a lot from your mistakes. But yet the grade should be good on it, be a take-home test. And everything in chapter 2, 3, and 4, there's some iffy stuff. In taxes, there is black and white and gray, okay? Black, white, and gray. Now, the black things in taxes is a definitely no. You cannot. Like in this one exercise, you cannot take that cousin as an exemption, even back under the old laws, unless that cousin lives with you. Okay? All right? The white is, and that one problem, she could take that brother since he lives with her if 4,000 was under a personal exemption for that particular year. If 4,000 was their personal exemption, it might have been $39.50 that year. She couldn't claim him because he made over $39.50. But now in taxes, there's gray areas. And tax professionals argue about the gray areas. The gray areas I take on my own return. We'll argue with IRS. If I were doing your return, I would take the black and the white. So I wouldn't have any trouble with IRS. Okay? But the gray areas for yourself is where you can save on taxes if you have a good argument. Okay? IRS, I've had about 3 dealings with them. One, I had a tax office, and that year was not the year of computers. It was in the 70s. And I would prepare the return. I'd have my secretary to rewrite it or type it, and I let her sign it. All right. The next year, time I got through 100 returns, IRS sent me a penalty, $50 per return. All right. That was quite a bit of money. They wanted to give me a penalty of $5,000 for 100 returns that my secretary had signed, not me. They said the law had changed. Well, at that time, Bluefield had an IRS office. They don't now. I went into Bluefield's IRS office, and I took a picture of what they had posted on the wall. All right, the tax preparers could let someone else sign if they gave permission. So I sent that to IRS and argued with them, and I gave them 15 reasons I was not going to pay $5,000. And the last thing I said, I don't mind to see you in court. All right, so IRS writes me a letter apologizing. And they forgave tax preparers all over the country for that same thing that they were doing to other tax preparers. They had not got out the information. It had not been posted. So they forgave me for that $5,000. Okay? So I'm the budget director for a church that had a large budget. And when I went in and took over as budget director, they were in a mess. The secretary was depositing the money and so on in a checkbook. There was no rules of internal control whatsoever at that church. But the biggest thing about the taxes, she hadn't paid quarterly taxes in a year. So your IRS, they send the church a bill for about $1,500 penalties and interest. Well, I helped the secretary to get caught up with those quarterly tax reports and paying the Social Security taxes on certain employees. All right. But still, they sent the church a bill for $1,500. Again, I wrote them a letter. And I said, first off, we are nonprofit. And I broke it down, the collections per month. What a big part of the collection per month that would be. And I told him the secretary had no training, plus she was brand new. She'd been there less than a year. And I was nice in that letter, and they were nice too, and they forgave that penalty. So I've been successful every time I've been dealing with IRS. Okay. So they're not as bad if you deal with them proper. And you know what you're talking about. So that gray area, I would argue with them any day. Okay. Now I'll get you a Scantron to put these on. But now, like if Terry and Matthew is not here or Hillary, whoever on Tuesday, you will just email me those answers by Tuesday by around 12 o'clock, and I'll have them. Okay. All right. Let me bring up a PowerPoint presentation. This company finally, I was able to download a test bank, and I think now they have everything available, PowerPoint solutions. Now that resource manual, I will download it too, in case you want final answers on a final return that you're doing. Okay, now what return were you supposed to hand in today? Was it today or next week? Okay, we do Tuesday then. Okay. That was what problem now, Jonathan, for somebody may have not picked that up? Problem 60, chapter 4. We went over that a little bit the other day, okay? Oh boy, I brought up corporations. All right, we'll start in chapter 5. And chapter 5, I think it's a little tougher than 2, 3, or 4. 2, 3, and 4 are exact. And some things we haven't done in chapter 4 yet is practice Social Security, how much is taxable, how much is not. But everything else, I think we did okay. Now, the gifts and inheritance, we will look at those again. What part is taxed, or especially a gift? If you're given a gift, what's the donor's basis? Or what's the fair market value on the date of gift? So those dates will matter when it comes to capital gains. Now, determine the realized gain. Realized is your total gain, simply total gain. Now, if I bought some stock for $1,000 and I sold it for $1,500, it's easy to see my realized gain is $500. I bought it for $1,000, sold it for $1,500. Now, is that $500 recognized? Now, realized may also be recognized. I don't see that word there. So you got to know the difference between realized and recognized. Here we realize 500 gain and we recognize 500 gain. Now, if this was a sale of a home and we sold a home for 200,000 and we had 150 in it, we have a realized gain of 50. But under the current rules, you don't have to pay taxes on it. So zero is recognized. Realized 50, recognize zero. So think about recognize and realize when we look at this chapter. All right, they do mention this recognize gain when a seller transaction has occurred. That's usually easy to determine. Now, holding period. Holding period is important. All right. Short-term capital gain. You'll see these letters mentioned. Long-term capital gain. You'll see these letters mentioned in chapter 5 and other chapters. This is less than a year. Less than a year. And this is more than a year, which is a year and a day. December 2nd to December 2nd is not a year and a day, unless you count both days. But you have a year and a day. All right. All right. Everything you own is a capital asset. Your car, your house. But on personal capital assets, like your car and a house, IRS is real nice. They don't let you take the loss, but you have to pay taxes on the gain. And they changed that about a house. Supposedly, if you pay $15,000 for your car and you keep it 2 years and you sell it for 10, I usually assume no gain or loss. I sell it for what it's worth. Of course, if I sold it the day after I bought it for a $5,000 loss, IRS don't allow that loss. If I sold it for $18,000 a day or two after I bought it, I'd have a gain that IRS won't taxes on. That's the difference. Okay. The holding period is important. If it's short-term capital gain, you pay ordinary tax rates on it. It was up to 39%. But if it was a long-term capital gain, most rates would be 15%. So I'd like to have the best rate. So if you're going to sell stock, try to hold it for a year and a day. If you're going to sell investment land, hold it for a year and a day. If you're going to sell bonds, hold them for a year and a day. So any capital asset, I mean, if you want to buy a coin collection, it's a capital asset. If you want to buy a stamp collection, it's a capital asset. All right, here's your 1 year deal, short term, and your 1 year deal or more, long term. And you'll get used to these abbreviations: gain or loss, long term capital gain or loss. So get used to abbreviations when you see them so that they'll become normal to you. All right. Now here's a biggie. Adjusted basis. Now you can sell certain business assets for a gain also. You're a small business. But we know that if you've got equipment in a business and you subtract accumulated depreciation, that gives you book value, and that's also its adjusted basis. The book value and adjusted basis may be one and the same. All right, but what if you have a commercial building you paid $200,000 for? You put it into business, you rent it, it's a commercial, it's a capital asset. Rental property is a capital asset. All right. What if this flood that's coming causes a casualty loss? I think the storm's supposed to start hitting. It's down to a category 2. It's supposed to start hitting, I guess, this afternoon. But it's big. It lasts up until Monday. West Virginia, I think, is supposed to start getting the rain from it, maybe on Saturday or Sunday. So, but if the flood damaged a commercial building and it brought that building down to 150,000, all right, and you got 50,000 insurance out of it. Now, if you put that 50,000 back in the building, its adjusted basis is still 200. But what if I only spent 40,000 of that $50,000 insurance money back on the building? That's adjusted basis then is 190. So other things besides depreciation can change your adjusted basis, such as insurance losses, fire losses, flood losses, what have you. You can sell off a part. All right, you buy, all right, capital additions. All right, I bought a house one time for a certain price. Later, I turned it into a rental home. But some of my capital additions to that house is I built a deck on it. Then I built in the downstairs. I did some capital additions. So if you buy a building for rent, you add on to it, that's a capital addition. All right, if you buy a business truck, you add a tow hitch to it, that's a capital addition. Or if you buy a truck and you add some kind of record hauling equipment on it, that's a capital addition. Okay? And that increases your basis. Capital recoveries from insurance companies reduces your basis. All right, is the property being transferred as a gift or bequest? No, you're going to sell it. And if this is yes, is the amount greater than the property's adjusted basis? If that is yes, you'll have a realized gain. But is the property being transferred as a gift? If it's yes, no gain or loss. As an identifiable event occurred, sale or exchange, condemnation counted. If no, then you have no gain or loss. All right, is the amount recovered greater than the property? If no, then you may have a loss. If it's a personal item, you can't take that loss. So that's just a little chart. All right, your realized gain can be bigger than your recognized gain. But recognized gain can never be bigger than realized gain. But realized gain, you may not be taxed on all of it. Recognized means you're taxed on it. Got to report it. All right. Jonathan knows what that math symbol means, don't you, Jonathan? What? Less than or equal to. And that one will be more than or equal to, wouldn't it? Okay. That's about the only thing I remember from some math class way back when. All right. Recognized gain can never be greater than realized gain. I just pointed that out. Reason why recognized gain doesn't always equal realized gain. All right. Here is our problems. All right. Now, if you buy something, if you bought a truck for your business for 15, the basis is your cost, isn't it? Unless you had depreciation, that reduces your basis. We're talking about adjusted basis. Now, gifts, let's look at that. And let's look at bequest. Now, to your basis, you have to add on shipping. You may have to add on other items such as new tires when you first bought it. And on a building, the loan on the construction loan is also added to the basis. All right, stock is deemed to be sold what? FIFO. All right, and what does that mean? First in, first out. In 2010, 2015, 2018, you bought 10 shares of stock at 50. 15, you bought 10 shares of stock at 60. We're just scribbling this down. And 18, you bought 10 shares of stock at 70. All right, you want to sell 10 shares of stock in 19 and 19, or 2019, that is. Which one are you going to sell? You're going to sell 10 shares. Which 10 do you sell? All right, the first ones you bought, $500 worth. Now, if you could use $700 worth, you might have a loss. But if you use $500 worth, you have a gain. But you have to use FIFO, first in. It's not inventory, but it's still FIFO. Now, this gets complicated. I want you to look at it on a gift. Here's Donnie's basis in a gift. Now, the donees. Now, if your uncle left you something, Hillary, he's the donor, okay? And you're the donee. You have to get all these payer, payee, and maker, and makee, cosignee, cosigner, whatever. Get the E's and O's straight here. But the E is the one receiving the gift. All right. Is fair market value of gifted property less the donor's basis? Is fair market gifted property less than the donor's basis? All right. Let's say the donor paid $10,000 for a piece of land, and they're giving it to you as a gift. Period. Your uncle's basis is $10,000. It's the donor's basis. All right. Let's say the fair market value is $13,000. Okay. Now, which way do I go? No or yes? She was given a piece of property, $10,000. Donor's basis. It's now worth 13. Do I go to no or yes? What do you think? Is fair market value of get your property less than donor's basis? No. Did donor pay gift tax? No. The donee carries over whose basis? All right, so she goes and sells that for $15,000. How much gain does she have? 5,000. So we got to know the basis of a gift. But it could have went the other way. So let's look the other way. Let's say the fair market value of that gift was $8,000. Now, which way do I go? Did Dolly sell property for a price more than fair market value at the time of the gift. Let's say she sold it for, all right, here's the donor's basis. 8 is the fair market value the date of the gift. Let's say she sold it for $11,000. Did donee sell property more than fair market value at the time of gift? Yes. Use donors adjusted basis and calculated gain loss. Do not add gift tax paid to capital basis. Use donors basis and calculate gain or loss. So if she sold it for 13, how much of a gain did she have? Well, if she sold it for 12, how much of a gain did she have? 1. No, we use donors basis. But sold it for 12, I'd have $2,000 gain. Okay, now if that was no, use the fair market value at the time of gift. So the donee sell property for fair market value at the time of gift. All right, let's say we sold it for $7,000. Use fair market value at the time of gift and calculate the loss. You'd use the 7 to calculate the loss, so it works in IRS's favor. So you need to follow these over. Good. They're in your book, I think. Now, the gift tax, we'll work on that later. You do have to know this little formula. Take the gift tax paid, fair market over fair market value at the time of the gift, minus donors adjusted basis, fair market value at the time of gift. All right. Let's say the fair market value at the time of gift was $10,000. The donor's basis was $8,000. And this doesn't rhyme right. They say in 2017, the annual exclusion equal $14,000 per person. I don't know what it is for 2018 taxes. But let's say that was $14,000. That'd be $2,000 divided by $14,000. That'd be 1/7. 1/7 of the gift tax paid. Let's say it was $700. 1/7 of $700 would be $100. All right. So gift tax added to donors adjusted basis. So we'd add $100 to the donors adjusted basis, but we'll work on that. All right. Property received because of death. Okay. Terry, do you have any kids?
No.
No kids? Husband?
On good days, yeah.
On good days?
Yeah.
Some days you don't plan it? All right. Does he have a will?
No.
If you're married, there's no children involved, usually, it's community property, that's usually not a problem. It's probably good to have a will, though. Especially if he had something, even you, wants to go to a particular parent, or nephew, or whatever. Do you have any kids, Matthew? Not married? Okay. You don't have any kids. But if you had kids, for sure, you don't have a will, you're leaving some assets. And if you're a single parent, you definitely don't have a will for that child. I have one scribbled up for secretary, somebody signed it would be good, but I want to change it. I want to get it legal, get an attorney to type it up, and so on. So, I'm not one to talk. I need to get a better will. Generally, your basis is the fair market value at the date of the death. Now, I've had people to come with me with inherited property from 15 years ago. They don't know what the fair market value was on the day of death. They didn't go check it out. But it'd be nice for you, if you are inheriting something, try to get a fair market value on it as near to the date of death as possible. Now, 15 years later, I guess you can only go look at the courthouse's property tax assessment. And if your land was based on 100%, then take their value. If it's based on 80%, you can calculate their value. Or you can get a realtor, then go back and look at what similar property sold for 15 years ago. But you gotta get some kind of value on it at the date of death. All right. Now, in this case, it is always long-term capital gain or loss. All right, it is always long-term. You don't have to worry about a year or more. Don't worry about the exception. If you live in a community property state, I don't know if West Virginia is or not, right? I think Virginia may be community property. There's only about 7 states that recognize common law marriage. Okay, so you bought a truck for $15,000. You keep it for 2 years and you put it into the business. The best thing you can do is use the fair market value. Let's say it's 10,000 or 11. So it's the owner's adjusted basis on the date of conversion. If it's lower, now if the fair market value of that truck went up to 16,000 for some reason, then you'd use 15. But usually it's the fair market value on the date of conversion. All right. I need to bring up my notepad for this example. All right. You bought 3 pieces of machinery. Okay. Now for those 3 pieces of machinery, you paid $112,000. But you want to depreciate them separate. You want a basis separate. Well, if you sold machine 1, what was its basis? All right, you got to take their fair market value on the date of purchase. And let's say this machine was 30. This machine was 40. And this machine was 50. So what's the fair market value of those 3 machines? What's the fair market value? How much? 120? We cannot record machine 1 on the books for 30, machine 2 for 40, machine 3 for 50, because we're on the cost basis in accounting, financial accounting. We use generally accepted accounting principles, and we put 112 on the books, credit to cash. But what am I going to debit machine 1, 2, and 3 for? Can you take a minute to calculate that? Take a minute, see if you can calculate what I debit machine 1, 2, and 3 for. Just give me machine 1. How do I find my basis in machine 1? All look totally puzzled. Okay. The what? I multiply it by what? 4? Well, it's three items. Oh, okay, let's see. All right, you do take the total cost of 120 and you put 30 over 120. That give you a fourth? And you put 40 over 120. That gives you a third, don't it? And you put 50 over 120, and that gives you what? 5/12. All right. Five twelfths is less than a half. So you got a fourth, a third, and 5/12. So what is a fourth of 112? How much? Then that's what we put machine one on the books for. And 1/3 of 112,000?
37,330.
All right. Do you know what that little math symbol means? If I put a slash over that 3, repeat. All right, then what is 5/12 of 112,000? How much? Well, it's got to be 667 or something. This has got to add up to 112. Is it? 667? All right. Does that add up to be 112? It has to. Does it? All right. Now, you had me end up doing that one for you, so we're going to do another one. Okay. You bought 3 trucks. Could be 4, could be 2. But you bought 3 trucks. Bought them at auction. You paid a dealer or whatever, a lump sum. And you know, a lot of used car dealers, they will go around to a new car lot and they may pick out 3 cars and say, I'll give you 20,000 for all 3 of them. And new car dealers do sell to used car dealers. All right. Well, let's say the fair market value of these trucks, and if you paid 40,000 for all 4 of them, the fair market value of one is 10. And one is 15. And one is 20. Now, how much do I have in truck 1 and truck 2 and truck 3? Clayton, what do I record truck 1 for? No, that's its fair market value. Hey, I got a deal on these 3 vehicles. I paid 40, their fair market value is 45. I cannot put 45 on the books. So how much do I put truck number 1 on the books for? How much? Everybody else got 8,888? You are multiplying 10,000 times what? What are you doing? You're multiplying 40,000. Sorry about that. Multiply 40,000 times what? What is 10 over 45? What? Let go 2 nines. 10 over 45 divided by 5. Yeah, be 2 nines. That's what I'm thinking. All right, Cole, what is the next one then? Truck number 2.
13,300.
Now we could say this last truck is the rest. But how much is this last truck? 17,000 what?
17,778.
All right, now we're going to be off $1 here. So you'd have to drop $1 off one of them. If they all rounded up, drop $1 off the best one you can before you make your accounting record, because you got a credit cash for 40,000, not 40,000 $1. Okay, now that's how to allocate bases. If you buy a group purchase, whether it's machinery or an auction or whatever, group purchases. Or if you're going to sell them or depreciate them separate, you need allocated bases. Now, stock, I told you the other day, if you had 100 shares of stock, you bought them at $50, how much did you pay for the stock? But you got a 10% stock dividend, and now you got 110 shares, and you don't have to pay a gain, so divide 110 into 5,000, and what have you got? Now, multiply that out, Jonathan. 110 times 45, 45, see if it rounds off to 5,000.
Yeah.
All right. So now if you sell a share of stock after you got this dividend and you sell it for $60, you got a gain of $14.55. You use not the 50, but you use this one. So again, our basis can change. Rights, I'm not going to worry about, but we'll look at it when we come to that part in the chapter. Accounts receivable is not a capital asset. All right. 1231, I have to explain what that is later. Inventories for resale, that should be a capital asset. But now my question is to you, if you had a letter from President Abraham Lincoln, would that be pretty valuable? Now, if you bought it from somebody, is that a capital asset? A copyright, an invention is a patent. A copyright is a song or a poem or a book. And seem like a lot of politicians and those affiliated with politicians, they like to come out with books, don't they? All these news people, they like to come out with books. But politicians come out with books. Hillary came out with a book. You buy it? West Virginia didn't like Hillary in 2016. They went, what, 60-some% for Trump? I think West Virginia likes to state their senator, Joe. Self-created musical works, taxpayers who create the property may now make an election to treat its sale or exchange as a capital if sold property is not a capital asset, then gains and losses is ordinary in nature. But we want to make it a capital asset if we can. I'll have to explain this and this to you later. 1231 and depreciation recapture. Let me show you real quick. You paid $20,000 for an asset, a machine. All right, you depreciate it down to 12,000. Now that's its book value. All right, you sell it for 14,000. What kind of a gain do you have? If its book value is 12 and you sell it for 14, 2,000, right? Now, as long as your depreciation is 2,000 or more, it's not a capital gain, it's ordinary gain. Now, if I sell it for 22,000, how much is my gain? 12 from 22 is how much? How much? So 8,000 recapture depreciation will be ordinary gain. 2,000 will be long-term capital gain. You got to sell it above its purchase price to be a capital gain. Because IRS is not going to give you depreciation as an expense, then let you sell it and get capital gain treatment. It's going to be ordinary gain. Now, I don't know if these rates change under Trump or not. But now, if you're in a 10% bracket or less, you know you might pay zero. But the normal person's in the 15% tax bracket. For capital gains. But you may be paying 25% on other income. All right, you got to combine your short-term gains and losses, long-term gains and losses, and net them. We'll practice that. All right, I'm going to stop right here on this presentation, and I'm going to bring you up a form. We'll look at this form for a minute. Remember, you can go to irs.gov and find any form you want. I'm going to search for a schedule. Schedule D. It brings me up Schedule D, I hope. Now, this form used to stand all along, all by itself, but now you have to put an attachment with it. I want you to look at part one. Short-term capital gain. Proceeds, cost, gain or loss. Now, you have to report some transaction, 8949, that just gives you extra room. Total for all transactions. Now, short-term gain from 6252, I don't know if that's selling a home or what, it's cash or losses. S corporation partnerships, carryover. But you get a net or short-term capital gain. And then we do the long-term. We do the long term the same way on Schedule D. So we'll be practicing the Schedule D, of course. Okay? Capital gains and losses. Now, go to the back of this form, though. Combine short term and long term. Now, you got to follow each little line if it's a gain or a loss. Now, if it's a long-term loss, you're going to take $3,000 a year. That's all. If it's a short-term loss, you're going to take it off. Short terms are better for losses. Long-term gains are better for gains, because they're only taxed at 15% rate. Short-term, we can take all the loss. Long-term, we're limited to $3,000. So we will get familiar with Schedule D. All right, I'm gonna drop that one. Okay, what we're gonna do, I want you to read chapter 5 real well for Tuesday. I want you to start on the even problems for Tuesday. However, since you got a take-home test, you don't have to work on the even problems, okay? But try to read chapter 5 and do the take-home test. Now, since we're gaining a class period, I'm gonna let you go today. We're gaining a whole period by giving you a take-home test. Okay, so I can let you go for 15 minutes anyway. Now, that is your deal. Have your test completed by 12 o'clock Tuesday. Bring the class with you. Have an email to me before 12 o'clock Tuesday. And I trust your honesty. Most of you live apart, you don't know one another except these two words. All right? All right. And I trust them, but they won't share information. I'll see you all Tuesday.